Good morning. My name is Keith Thompson. I'm the co-founder of Focus Distribution. We're a company that specializes in helping asset managers share their unique stories with the financial services community. We currently represent 4 money managers and service over $3 billion in assets. Our goal is to help educate and inform the financial services community. Today, we're fortunate enough to have the portfolio management team from Wedgewood Partners out of St. Louis, Missouri. We're going to discuss their large cap focus growth strategy and how they're navigating these tumultuous markets. We are now joined by Chief Investment Officer Dave Rolfe, Senior Portfolio Manager Michael Quigley, and Portfolio Manager Chris Jerson. Gentlemen, thank you very much for taking the time to join us today. Dave, I'm going to start with you. This strategy's got a 30-year track record. What's the fundamental thesis behind the large cap focus growth strategy?
Well, what we've done all these years is we've married the classic tenets of what we consider to be growth company investing with the classic tenets of value investing. And we've always believed this idea of growth and value is the same side or the two sides of the same investment coin. And we've fully embraced over the years the maxim, price is what you pay, but value is what you get. And specifically, when I'm talking about value in this instance, Keith, we want to capture the value creation of better of breed businesses that we typically hold for many years.
Okay. Well, look, when you're doing something for 30 years, and I'll throw this out to Michael, things must have changed. You must have had observations in the market that have informed maybe revisiting original thesis. Is there anything different now than when the strategy started, or is it just you've maintained those original tenets and you just have changing markets around you?
No, yeah, the philosophy and the process has been completely stable over this time frame, and the backdrop against which we apply that philosophy and process has dramatically changed. We haven't changed our focus. Our valuation discipline has been maintained, despite the proliferation of large cap businesses that don't have, profitability. We invest in high quality, competitively advantaged businesses that have the ability to grow at double digits over a multi-year time frame. So what's in the portfolio might be different from year to year, or maybe even cycle to cycle, but the philosophy and the process stays the same.
Every manager has their ups and downs, and over 30 years, I'm sure you've had plenty, but what are maybe some of the biggest lessons that you've learned along the way that have informed the process?
Yeah, well, certainly being a focused investor, and there are a lot of managers that will say that they're focused, and they may own 35 or 40 stocks. I mean, we're really focused. We only own 20 stocks, and there are 20 different businesses. So one of the really important elements of our thinking and how we try to communicate that with our clients is that just by the fact that we own 20 stocks, and our goal is to look very different than our active peers as well as the large cap indices. We know every day we come into the office that our portfolio looks very, very different than our peers in the various large cap indices. We know that we're going to be out of sync quite often with the flavor of the day, the hot stocks of the day. And ultimately, which we believe focused investing has significant competitive advantages. But for those that are successful as focused investors, you simply have to have stone cold discipline to stick to your philosophy, to stick to your process. When there are times where we may think we're out of sync, certainly our clients may think that we're out of sync. But if we can't have that discipline and we're chasing the hot dot of the day, we often become traders instead of true investors. And related to that, this idea of being a true long-term investor in these terrific businesses, to be successful, it's a marathon. It's not a sprint. But unfortunately, shorter-term performance pressures for all of us in this business make it much more of a sprint than a true marathon, and that relates back to discipline.
Yeah, I would just say, as someone who's been here for 7 years, not as long as my two colleagues here, I've already actually seen some. I've seen when the cycle was kind of not in our favor, and I've also seen when all the these businesses that can't sustain themselves with their cash flows and don't run profitable businesses. I've now seen when that doesn't work out very well, and we tend to do a lot better in that sort of situation, but. It's been interesting to me as a newer person to the process. I've sort of been an outside observer for a little bit of this early in this time. And so I got to watch and see, what happens when, do we say that we're long-term investors and we have our discipline and it turns out we're losing for a couple of years and we better panic and go chase something else. And we definitely did not do that.
Wedgewood prioritizes profitability as a standard for ownership in the portfolio. It seems like an obvious characteristic, yet many large cap growth managers seem to disagree. Why do you think that is?
Honestly, we don't even view this as a philosophical difference at Wedgewood. We think that companies need to be able to finance themselves unless you have, with their cash flows, unless you have free money available to them some other way. So other managers can get away with investing in companies that aren't able to sustainably finance themselves when there are free equity markets where they can just go to the equity markets, raise capital all day long at higher prices. They also don't need to be able to finance themselves when there's free debt financing available. And, we do find when you hit periods where it seems that there's going to be free money and the stock market's going to go up forever and interest rates are going to be low forever, that people can invest in those companies that don't finance themselves, and you don't really see any problems. And that can leave people like us looking like dinosaurs, we think.
This idea of industry leading profitability, high levels of profitability, whether being some combination of return on equity, return on capital, return on investment capital, cash flow return on invested capital. That's our process North Star. And key to that, if a company has demonstrated or generated significant amounts of such high levels of profitability, particularly relative to their peer group, that to us is prima facie evidence of competitive advantage, which underscores it's the foundational element for us to be long-term investors. What's really interesting, perhaps just a related industry, large cap growth industry observation, many large cap growth managers, their process is significantly based on momentum, a combination of sales momentum, earnings momentum, even stock price momentum. Again, this gets back to this idea that a lot of money out there is managed despite their professed beliefs on long-term investing. When you look at the portfolio turnover of many of our peers, it tells a different story. And I think it's telling a story of momentum, which again gets back to this idea. Too many in this business, in our view investing as a sprint, quarter to quarter, year to year, instead of a marathon, which we measure ourselves and our companies we invest in over a multi-year time frame.
I've said for years that while consumers own you based on your 3-year, your 5-year, your 10-year, your 30-year track record, sadly, I think our industry has given them access to their dollars every waking hour of the day, and they judge you based on rolling 24-hour returns. So it can be difficult, I would imagine, as a manager of long-term assets to kind of keep your eye off the shiny object of what's going on today and get it back onto the North Star, as you've mentioned. So look, when you look at this past decade, the FAANG stocks drove a significant portion of the performance, both of the S&P and the Russell 1000 growth. You did own some of those names. Can you give an example of a name, maybe, Dave, that you didn't own that drove a lot of performance of those indices, but just didn't fit the standard that you were looking for?
Sure. A couple of names in FAANG. Maybe throw Netflix in there. Certainly Amazon. We had owned Amazon many years ago. But again, when we filter these businesses, and these are two very, very different businesses, but when we filtered these businesses through our process, both of these businesses went through a significant period of time where they were heavily investing into their futures. They were certainly driving sales growth, but there really wasn't much that's coming in the way to shareholders. And in fact, we were befuddled for many years. I'll be quick to admit that. Take Netflix as an example, a big winner during that heyday of the FAANG period, but quarter after quarter, they would generate huge amounts. They would burn through huge amounts of cash. And in fact, and Michael and Chris can correct me if I'm wrong, but I recall in numerous earnings conference calls, the CEO, Reed Hastings, would say their business strategy is to generate losses because that's their way to grow. And those are businesses that we have a very hard time intellectually wrapping our head around. Those business models may be great for corporate insiders, for those that are compensated significantly with share-based compensation. But as shareholders, we want our piece of the pie too. And they're never seeing, with those businesses for many years, it seemed that shareholders were only getting crumbs.
Michael, do you have something to add to that?
Yeah, we used to own Amazon earlier in around 2011, 2012, and it was trading at a multiple that we thought was relatively cheap for a good growing business with what seemed like competitive advantages. After the multiple ran up, valuation got pretty expensive relative to what we thought for what future returns would be. We ended up selling. More recently, we haven't owned Amazon, again, mostly because it's had an expensive multiple. And when we talk about valuation, we're talking about future returns. And if we think future returns are going to be less than what the benchmark is going to offer us, or a competing alternative to any single stock, we try to find stocks and businesses that will generate superior returns. So valuation is another way we talk about future returns and future expected returns. And over the past 5 years, Amazon has underperformed relative to the Russell 1000 growth. And that's part and parcel of our valuation discipline. When we try to avoid businesses based on expensive valuations, again, we're saying that we think future returns are going to be less than what we need to get for our clients.
Yeah, when I hear growth managers and I hear valuations, it seems like that it's anathema to the entire industry that most growth managers don't think in those terms. Do you have a name that maybe was one of those darlings that at some point in time you said these valuations just don't make sense, and I can't continue in good conscience to own it in the portfolio?
One that comes to mind is NVIDIA, which is now a current darling of the age. Back in 2019, we sold a pretty big chunk. We sold all of our Berkshire Hathaway, and a pretty good percentage of that holding went into NVIDIA. And NVIDIA is, it's a cyclical business, and extremes in valuation have made that stock extraordinarily cyclical, if you will. And we bought that stock back at now this is pre-split at 175, and we added a little bit to it shortly thereafter, but and we trimmed it along the way. But it was a moonshot, and it became an industry darling again. But the valuation got so high that the market took it away from us. We sold at, ultimately, the last sale was at about $550 a share. So that's an example that if you're patient enough, you can get these great businesses, these industry darlings. We've learned over the many years, it's rare that we don't get a chance to own one of the darlings of the day when they're less than darling. But if the underlying business is still strong and the stock gets re-rated, it can really generate significant performance. And so I think that's a more recent example where the market simply took it away from us because the valuation simply became egregious. In the most simplistic terms, great business, lousy stock because of the high valuation.
When you think about a focused portfolio of 20 names, you indicated that you feel very comfortable that you have a diversified portfolio. Well, that goes to portfolio construction. How do you determine, how to diversify a portfolio? What are some of those factors that go into saying at 20 names you are a diversified portfolio?
Part and parcel of our process is that if we get down to about 30 businesses, maybe 35 businesses that are superior, we understand what has made them terrific in the past, and we believe that we have a high level of confidence that the competitive advantages of these businesses are sustainable, and we want to own them in the future. But as Michael mentioned, or a key element of our diversification is to have very different business models. So as an example, for many years, we've owned Visa, but we haven't owned MasterCard at the same time. The thought being, in a 20 stock portfolio, we make Visa one of our larger holdings that has, importantly, an outside weighting versus the various benchmarks. That is a key element of focus. You can't do that unless you're focused. In addition to that, if we are wrong in our thesis, we get the business model wrong, or we get the valuation work wrong, again, if we own MasterCard, we're probably going to be wrong on MasterCard as well. So again, this idea of 20 businesses, they're very different businesses. And in the large cap space, you also have the advantage of significant geographic element in these business models. And you look at some of our top holdings, they do business all over the world, unlike maybe a small cap company that might be very local, just in a few states, or it might be US based alone. And so we have found over the years, and a testament to this idea, better of breed businesses, being thoughtful on valuation, prudently diversifying our portfolio in just 20 names. In the last two significant bear markets where the market got cut in half, we actually outperformed in those two bear markets. And it was a combination of those three elements that proved, that was our proof statement that you don't need more than 20 stocks or so, as long as you can layer in those three key elements that I mentioned.
We keep talking about some of the challenges or the concerns about a focus strategy. What we haven't talked is the other side of that story, which is when you own a meaningful name relative to the index, you can generate a lot of alpha associated with those names. Do you have any names in the portfolio that maybe were not enormous weights in the indices, but were larger weights in your portfolio that generated a lot of alpha?
Yeah, the good news about a focused portfolio is pretty much every holding we own in a 20 stock portfolio is going to be meaningfully, if not massively, overweight relative to the benchmark's weighting. And I think right about now, in the middle of 2023, there's probably only about 2 or 3 stocks in the benchmark where we're probably not going to be able to be overweight, just given that the maximum weighting we have in the portfolio is going to be 10%. And we're getting to the point where there's some holdings in the benchmark that are going to have higher than 10% weights. But other than that, I mean, in a 20 stock portfolio, you figure an average position is about 5. And then the average weight of a 500 stock portfolio, which would be something like a benchmark, is going to be, a very small fraction of that 5%. So nearly all of our positions are meaningfully overweight, conviction weighted. We don't see a whole lot of purpose in going into a position with an underweight.
It's interesting. You guys have managed to outperform the Russell 1000 growth and the S&P 500 over the past 30 years by about 250 basis points a year. Yet many consultants are saying, hey, why don't we just index away that large cap growth index? It's a crowded field, everything's homogenous. How do you accomplish, getting that 250 basis points of excess performance relative to these things? And how do you convince the investing community that while indexing may be a solution, it's not the only solution?
Well, simply it's focus, Keith. Yeah. It is, again, it's as simple as that, but it's as difficult as that. And in investing, sometimes if you can maximize something that's very simple, simplistic, it has tremendous power. So as we say repeatedly, focus is our edge. And this idea that focus is durable, it's repeatable in all market environments. And we believe how we employ this idea of focus is a significant competitive advantage versus our peers in the various indices. We come in to work every day intellectually, given our philosophy and process, believing that we have a long-term tailwind in our battle to outperform our peers and the benchmark. And I think, simply put, our 30-year track record of outperformance is a significant proof statement that how we employ focus can outperform peers and the benchmark. And related to your question, the large cap space is very efficient. I can't think of a more efficient space in investing, where the headwinds versus active management are the highest. Yet again, this idea that any active manager that hopes to outperform, that has a prayer to outperform, they have to have a differentiated philosophy, a differentiated process, again, stone cold discipline. And that's what the three of us here at Wedgewood as a team, and again, this idea as this team that we're all PMs, we're all analysts, we're all generalists, we all take ego ownership of every stock in the portfolio. That in itself is part and parcel of focus. And we actually think how the team works together is another competitive advantage. Teams can't work like we do if they have 40 stocks or 50 stocks or even 100 stocks. So you add all of that up. And again, we earnestly believe that every day we come in the office, we have a significant tailwind given how we approach active management versus our peers and versus those that insist on indexation.
When you look at the recent tail end of the last decade, I'll stipulate that no two markets are the same, but is it reminiscent of markets that you've seen in the past? And, relative to that, does it inform anything that you're doing at a portfolio level?
Seasons come and go. We've been in an extraordinary period of 10 years of zero interest rates. Certainly the pandemic bust and then boom, and maybe the hangover from that boom that all companies and investors are dealing with. But at the end of the day, we earnestly believe that if we stick to those classic tenets of growth company investing, classic tenets of intelligent value investing, those are foundational elements. And in the fullness of time, despite what might be the current economic environment, what may or may not be different, those are never arbitraged away. They don't go away. They are the scales in which the weight of anybody's philosophy and process must be measured. And that has served us well in our long career. Keith, it's been interesting. I've been doing this since the mid-1980s. So I've experienced 3 stock market booms, and I've experienced 3 stock market busts. And related to that, I've experienced 3 periods of significant client irrational exuberance. And I've also experienced 3 periods of client depression. And that's what this market of ideas in which we compete. And thank goodness we do have those. If we didn't have volatility, either on the upside or downside, it would be very difficult for us to employ our strategies. So seasons come and go, but we stick to those foundational elements of how we think about investing, and they've served us well over time.
All right. Well, so I'm going to leave you with one final question that's a little bit more forward-looking, but kind of plays into your theme of seasons here. There is a lot of noise right now. You've got a banking crisis. You've got a concern about debt ceilings. You've got a war in Ukraine. You've got an election cycle. How do you determine as portfolio managers what is in fact meaningful in all that noise, and how does that inform what you're doing on a day-to-day process in this portfolio, or does it inform what you do on a day-to-day process?
There's always noise in the market. It's nearly guaranteed based on the way information is created and transmitted. People have been saying there's a recession for over a year now. And we haven't seen anything aside from pockets of normalization and maybe the unusual comparisons due to year ago Omicron closing and reopening. So there's always something going on. And most investor timeframes are very short, 3 to 6 months, maybe even shorter than that. I'd like to think investor time horizons are getting longer, but they're probably not. So we really just try to stick to businesses that are competitively advantaged, that have business models that can navigate whatever is thrown at them. Because the macro, again, could be changing, not changing. These businesses that we own have levers at their disposal that they can pull regardless of what's going on to drive high levels of profit, to drive growth. And then we add in our own portfolio management, risk management through valuation and making sure we're going to get a good double-digit return out of whatever management's doing.
I would just add a couple of thoughts, maybe from the old man on the team here. Certainly, investors need to be able to discern what's true information and what is just noise. And every year, it's more and more noise. People can look at their portfolios on their smartphones and get instantaneous updates. They can get instantaneous news as fast as we can. And so obviously there's that key element of sifting through the noise, what's information, what's rational information, and even a subset of that is what is actionable information. At the kind of even though we're bottom-up investors, certainly at the industry level, we need to be cognizant of new information flows in various indices. But I am reminded, and this is where I'll put on my senior hat from the investment team. I've been doing this now since the mid-'80s, and I can't recall one time in the Forbes 400 if there was an economist or a geopolitical analyst that ever made the Fortune 400 list. And so I think a key element of what we've learned at Wedgewood is what to ignore. And that's just as important sometimes of trying to discern what is key information and what's relevant information and actionable information. We try to tune a lot of that out. And just owning 20 businesses allows us, again, not to torture the phrase here, but our ability to focus on in a big scheme of things, on a relatively small subset of information and news flow, I think makes us better investors.